many thanks for your attendance today. We're going to talk you through our record results for the first half of 2021 and give you the opportunity at the end to ask any questions that you would like to ask. Looking at just some context about us as a group for those of you that don't know that much about us, we are the UK's largest property franchisor. We operate 9 brands across the group. 3 of those are national brands, those being MartinCo, predominantly lettings, Hunters, predominantly sales, and Ewe Move, which is our challenger hybrid national brand. And then we have 6 regional brands: CJ Hole, Parkers, Country Properties, Ellis Co, Whitegates and Mullocks. In terms of the scale that gives us, it's significant. We have 438 physical offices, so they're trading branches excluding Ewe Move. Ewe Move has 152 operating territories currently. We manage as a group over 73,000 managed properties, which I think puts us number 2 in the country. And last year we sold in excess of 20,000 properties. This year that will be much closer to 30,000 properties, but in a normal year, circa 20,000 properties. Vision for the group is to achieve an increasing UK market share of lettings, estate agency transactions and property-related financial services using a proven franchise model with multiple and clearly differentiated property brands. That's a little bit about us as a business. In terms of our history, Richard Martin, our current chairman, founded the business back in 1986, opening his first office in Yeovil. He then ran that successfully for a number of years and then sort of got the franchise bug, having been to America and looked at sort of the Remax story over there, and launched his first franchise offering in 1995 and pretty much ran that business from 1995 all the way through to 2007, by which time he basically signed up 100 trading franchise businesses across the UK, offering lettings only. The group continued to grow, and in 2012 they decided that they wanted to offer sales and lettings and therefore launched their sales service in 2012 and grew the business to about 150 branches up until 2013 when MartinCo PLC floated or listed on AIM. We then set about acquiring additional franchise brands, and in 2014 bought Legal & General's franchise business, the Xperience group, including Whitegates, which increased the footprint to 282 franchise offices across the UK. We then acquired Ewe Move, our challenger brand, in 2016. We rebranded to the Property Franchise Group in 2017. By 2019, we were managing 58,000 properties. In 2020, we launched our new financial services business. And this year, which has been incredibly busy, we've acquired the Hunters franchise group and also announced a strategic financial services partnership with LSL. And last week acquired an 80% holding in the Mortgage call centre based up in the Northeast. So that gives you a little bit about us and what we've been up to and how we started. Last September, we had 6 months with COVID where, we were supporting our franchisees, and we bounced out of the sort of lockdown 1 and the market picked up really, really quickly. And we put in place some sort of stated aims that I'm going to update you on today in terms of what I saw as our growth initiatives over the next 2 to 5 years. And those were lettings growth, organic lettings growth. How could we drive lettings turnover in our franchise business to drive more income to our franchisees and ultimately more income to us? Second pillar of growth was expanding our residential sales footprint, and that's sort of been a little bit sort of difficult to gauge this year because the market's been so strong. The residential sales market's probably been the busiest period I've ever known in the estate agency. But we have a stated aim that we want to work with our franchisees to improve locally their market share in the residential sales part of the business. Our third pillar of growth was to double the number of territories we operated out of in our Ewe Move brand by the end of 2022. So take it from 115 this time last year to 230 by the end of next year. Financial services, at the time of stating these sort of growth initiatives, we didn't really have a financial services proposition. We've lastly signed that contract with LSL, and our aim is to have a pool of 100 financial advisors supporting the group from a financial services perspective. Acquisitions at the time, we said that, we wanted to continue to do local letting book acquisitions for our franchisees, but we also had an aspiration to look at the bigger type acquisitions in the marketplace and consolidation within the franchise market. And subsequently in March, we completed on the Hunters acquisition. And then tying that all into a sort of best-in-class digital marketing platform where we centrally utilize the data that's collected by all of our franchise offices, communicated with those consumers and drove leads back to the offices in terms of house sales, lettings, insurance sales and financial services. So they were the growth initiatives that we talked about this time last year, and I'll update you on those as we get through the presentation. In terms of summary for the period, so from March through to today, we've had record financial performance driven by a very active residential sales market. We've made significant progress against our strategic priorities and our growth initiatives. As I talked about earlier, we acquired Hunters in March 2021, and the integration of that business is going extremely well. They're having a record year, and we last week completed on the acquisition of the Mortgage Genie. And I think, what gives me confidence for the future, we'll talk about the market and the activity that we're seeing at the moment, but, we've been delighted that market's been there, but we're very, very focused on the opportunities that exist in our day-to-day business and where we can add real value in terms of growing each and every franchise that we operate in, and obviously our own results through the strategic growth initiatives. So that's a summary of the period that we've just been through. Now I'm going to hand you over to David, who's going to talk about the financial review. David.
Thanks, Gareth. Good afternoon, everybody. Well, what a year! It's a year where it's a delight to have to present these financial numbers. I think where to start? Well, you've got to remember we've got just 3 months worth of Hunters in these numbers. I've done quite a lot of work that sits in the RNS just explaining where we are without those 3 months of Hunters in our numbers. 1 or 2 of those I'll pick up on as we go through, just to give you some context. But let's get started. Network income for the first half of this year, 89.4 million, up 118%, going to be a 200 million plus network income year for the group, which is considerable. Group revenue up 117% to 11.1 million pounds. If you were to strip away the Hunters edition, that's 4.1 million. So you'd see 7 million and a 37% growth. And, 2020 was a bit of a strange year in the first half. If you compare that like for like to 2019, we'd be up 29%. So it's a good solid growth in the group this year with or without Hunters. Management service fees up 73% to 7.3 million pounds. Without Hunters, that's about 5.7. So we're up about 35% on 2020, up 23% on 2019. So again, you can see royalties, which is always a very important income stream for us, has progressed really well this year. And then just look at the underlying business and what that's doing. Adjusted EBITDA up 108% to 5.2 million this first half year. And adjusted operating margin up just a little bit, 47% over 45%. So a business that still generates a really good quality of margin, but our scale has just increased considerably, whether it be revenue or earnings at the end of the day. And then at a headline level, profit before tax up 57% to 3.1 million pounds. Not too much of that's been contributed by Hunters because there's a fair bit of costs in acquiring a business and you've got to take those out. So only about 200,000 from Hunters and 900,000 from the group that was. But still, good growth over 2020, really encouraging to see. And where does that leave us? Well, if we take a adjusted earnings per share, so take the tax off and the underlying fully diluted performance in the business, 14.9p of adjusted earnings per share in the first half of this year, up almost 100%. And I went with that first because I think that's important. That leads us on to a discussion about dividends and what should we be paying. And we as a board had to recognise just the sheer growth in our business, the generation of earnings that is here and will continue, the growth in cash generated, and that will continue as well. And in line with many of the other percentage increases, we decided we would reflect the new scale of the business and increase the interim dividend. So that's 3.8p this half year over 2.1 last year, 81% growth. We're heading towards about 11.5p or so, I think, for the full year. So on current share price, we're near as damn it, getting to about 4% yield. And then just to talk a little bit more about what's happened cash-wise. Net cash generated from operations was 5.4 million last year, full year. This year, just in 6 months, it's just over £4 million. So clearly, we're going to generate a lot more cash this year than we did last year. The benefit of that is that we see the net debt falling, and it will fall back quicker than we thought. So we're probably going to be in a net debt position of about 2 million this year. Certainly by the end of the first quarter next year, we'll see ourselves in a state where we'll be, if not net cash positive, we'll be at break-even position, which is fantastic for us. And there's a bit of guidance in the market I just wanted to allude to before I go on to mix and what's happening in the marketplace itself right now. And the guidance, Cenkos guidance was, at an adjusted PBT level, 8.3 million for 2021. We've generated it, or we will generate about another £1 million over that in the group as underlying profit. So that's going to take us to about 9.3 for this year. It's reflected in numbers out from Canaccord. And next year, even with a slight softening in the market, all our organic growth initiatives, we've said at least another £1 million of underlying profit. So that adjusted PBT for 2022 should be about 10.3 million as we stand today. So, good growth from us so far, plenty to come, I think, over the next couple of years. Some of it reflected in numbers, some of it we've still got to get on with, and projects that we've got on the go, and when we're confident where we're heading with those, we'll take a review of what we've put out, but that'll be full year results, I'm sure, before we get to that point. And then onwards, just to revenue, first half of this year over first half of last year. The significant change this 6 months is the owned offices that we've picked up through the acquisition of Hunters. They have 10 offices that they own, all 10 engaged in letting agency services and 8 in sales agency services. Their DNA was in corporate owned offices, so that's where they came from before they became a franchisor, so that they're well-run businesses. We look at those and sort of toy with the idea of what do we do next. And I think right now we're going to buy some lettings portfolios, and we're going to bolster the lettings part of that business and increase the margin we get from that, contribution to the bottom line. Sales will keep flowing through depending where the market heads for this year, and we'll leave that as is. That's good contribution right now, but that's the biggest change over the 2 periods. In mixing royalties, traditionally as a business, we've been about 25% of our royalties coming from sales and 75% from lettings. And last year, half year, similar sort of trend as you see on the right-hand side. On the left-hand side, where are we right now? Well, we're about 50-50, including Hunters. So that shows the growth of the group. And if you were to take Hunters out of there, we're about 60% from lettings and 40% from sales. So, it's true that the sales market is having a dramatic impact on our earnings and also on the royalty mix at this moment in time. But underlying that, there's a 9% growth in like-for-like in lettings MSF, 18% growth overall. That 9% growth like-for-like is something that I don't recall for a good few years. So it's a strong market in a place where the probably transactions are just starting to pick up as they do every year at this point in time. So got more to come. But 9% for us is good growth. I think it's coming primarily from landlords, I'm sure, who are paying more fees, a bit of rent inflation at this moment in time, a little bit of movement around in the market as people leave their existing properties and move elsewhere. But there's more of that to come in terms of people moving. I'm sure there's a bit more to come in terms of rent inflation as we move forward. And they, probably that summarises lettings and where we're up to. This is the market now. We always use these slides because what's happening in the high street brands, excluding Hunters, and we've got enough of a footprint to be able to see what's happening in the market. So Lettings MSF on the left-hand side, 2021, a bit of a slow start, started to pick up. Clearly March was a good month, but it is most years. Then a small drop back and pick up again. The lettings MSF this year, 2021, is following a similar pattern to 2020. It's different to 19, and that pattern in 19 had been a similar pattern for about 6 or 7 years prior to that. So there's something changed in the lettings market, people behaving slightly differently. No doubt it's based around COVID and some other factors, and we just have to keep an eye on it. But if the market in this year follows what happened last year, we'll have a good old run right through to the end of the year now, which is good to see. And then on the sales side, MSF on the right-hand side, 2021 was a slow start. Got to February with quite significant sales agreed pipelines, still back of them going the full way and completing. Then there was a worry about stamp duty relief ceasing in March, and that pushed a bit of extra activity in the market there and deals completing. As soon as they were completing, our sales agreed pipeline was building back up. So we were saying very little net change in the sales agreed pipelines. The same things happened in June. Bank of England was open 24 hours a day to get transactions through. Everyone worked very hard, I'm sure, to get all those transactions through. Pipelines didn't really change much as a result of it. And just to sort of run on, although it's not here, July and August, slightly softer. I think all of us taking holiday at the end of the day. And September has started off again pretty well for us. I mean, probably as higher volumes we've seen in 5 or 6 months. And right now, it's the end of stamp duty holiday in September, so that will push sales transactions through. Where will our sales agreed pipeline go? Well, so far, if it follows the history, it won't change very much. And given that they're coming, those sales will come to fruition over the next 5, maybe 6 months. We clearly, wherever we see our sales agreed pipeline end in September, really defines where we are to the end of the year on sales and sales MSF, and indeed probably a fair chunk of first quarter of 2022 as well. I'm going to end on cash generated in this section. I touched on it earlier. Cash generated from operations, 5.4 million for full year last year, 4.1 this year. If you sort of look at the free cash, that's the cash that we've got available either to reinvest in the business or to pay as dividends. 21p a share this time, full year last year. We're already at 12p for the 6 months. Where will we go? Well, I think we can all reasonably estimate that's going to be more than it was last year. So, really encouraging to see that we're still generating per share, given that we've had some dilution with the acquisition of Hunters. We're still maintaining that level, and consequently, we will be off our free cash yield as well. On the right-hand side, net cash. So at the end of the half year 2020 versus the half year 2021, we'll be up about £1 million. So it was about £6.1 million this time last year. But if you look at the sort of cash usage, we came in with 8.8 million. We've spent a bit, borrowed a bit, quite a bit, as you can see, and yet we still only have seen our net cash go down £1.7 million. And now that will just build to the end of the year. So we're a very cash generative business. We convert more than 100% of operating profit, or indeed EBITDA, into cash. We've done that for a good number of years, and that follows from being very capital light and very little draw on working capital. We're usually pretty working capital neutral in any year. And with that, I'll hand back to Gareth.
Thanks, David. Great. So that gives you some idea of the financials. I wanted to then go back and talk specifically about our strategic initiatives. And I think, and again, I'm sure you'll have some questions. The market so far since lockdown 1 in August 2020 has been far busier than any of us could have hoped for. Probably the busiest market I've been involved in 30 years in the industry, and shows no signs currently of letting up. But what I wanted to talk to you about today is sort of our internal plan in terms of, irrespective of the market, what our plans are and how we're going to drive value forward over the next 2 or 3 years. And that comes back to our strategic growth initiatives. So in terms of taking each one in isolation, lettings growth, David touched on this. This year we're seeing 9% growth across the lettings book. The lettings market has been extremely active for as long as I can remember. So every time you put a property on the market, multiple applicants that would take that property in a very short space of time. what COVID did and what this year with the evictions ban has probably meant that people have stayed in their property longer than they would have done, just didn't want the change. And what we haven't seen yet is that sort of change to the moving either into a property they buy themselves or a different residential lettings property. And to have sort of 9% growth in the first half of the year is really, really encouraging. What's been left behind is rent inflation. So nobody's been putting rents up. There is a case over the next 2 years that we will see rents increase across the portfolio of 73,000 managed properties. And that could put 5 to 10% on our franchisees' bottom line and indeed our own. So there's a huge opportunity to focus on 73,000 properties that we've already got and make sure that we maximise the income for our landlords, which in turn maximises our income. And we've got some sort of marketing initiatives in place at the moment in line with our digital marketing strategy to drive that out. There's also been a massive change in legislation in the industry that makes managing your own property, which is a significant part of the rental market, much more difficult. So the harder and the higher that barrier becomes, the more likely landlords are to outsource to a professional specialist. And again, there's initiatives going on to drive the portfolio number up. So this time last year, we had 58,000 properties under management. Today, we've got 73,000 properties under management as a result of the Hunters acquisition, to be fair. And that gives us, a significant number in which our franchisees can grow their income. The next pillar of growth was residential sales activity. So we wanted to grow our local market share in each of the offices that we had in the old TPFG brand before we bought Hunters. And what we've brought in is some specialist help to help our franchisees understand what they need to do to be a recognised residential sales specialist. And irrespective of the market, we've seen some really good results from that work, and we'll continue that over the next few years. The third pillar of growth we talked about last year was doubling the size of the Ewe Move network over the course of the next 2 years. So this time last year, when I was talking to everybody, we had 115 operating territories, and our ambition was to grow that to 230 by the end of 2022. We just had a record 6 months in terms of sales of new territories. We sold 37 in the first half of the year, and we now operate out of 152 territories across the business. So we're well on track to meet that 230 target by the end of 2022. We've invested a lot in recruitment, and that's driving leads on a weekly basis and delivering the territory sales. So Ewe Move recruitment going really, really well. The biggest change in the group, I guess, is financial services. If I look back to when I joined in February 2020, the old property franchise group had no real financial services proposition for our franchisees, which I was surprised about. I was even more surprised to go into Hunters and find out that they also didn't really have a financial services proposition. But what that gave us was an unbelievable opportunity to go into the market and negotiate really preferential terms as the second largest estate agency group in the UK. And back in March, we did the deal with LSL, which gave them a 5-year sort of distribution agreement where we would work together to maximise the financial services opportunity within the business. And our stated growth aim is that we would have 100 financial advisors servicing the network by the end of 2021. And I wanted to update you on that today. So as a result of the embraced LSL call centre, which has about 35 financial consultants operating out of it, our own acquisition, the Mortgage Genie, which has 12 currently and the ability to probably double in size quite quickly, the Hunters financial services business that has the potential to grow to about 10 financial consultants, coupled with franchisees wanting to build and set up their own financial services business, and we've got 80 of those, that we should be well past that 100 financial advisor target, certainly by the first quarter of next year. I'm not sure we'll do it by 2021 because there's delays with the FCA. They're really struggling at the moment. They used to take about 3 months to turn an application around. They're now taking about 6 months. But the general appetite from our franchisees has been incredible. We're starting to pass leads now to LSL. We're starting to do sign-ups. And that's a really big focus from now until the end of the year to drive a pipeline into 2022 that will add significant bottom line improvement to us and our franchisees. Fifth pillar of growth this time last year was acquisitions at a franchisee and a franchisor level. So taking the franchisee level, this is where we help our franchisees acquire local lettings portfolios to add to the 73,000 managed properties we've got currently. And that market's been pretty subdued in the last 2 years. We've done 7 so far this year. We've probably got a pipeline of about 10 that should complete by the end of the year. But this is a really big focus for us. And what we do is we provide the sort of help, support and expertise to do the due diligence on those acquisitions. And in some cases, we will help the franchisee fund those acquisitions. But in the main, they'll take their own finance or pay that out of profits that they've made in their business. So that's a really big focus for 2022. We believe there'll be more people looking to sell once the market cools a little bit. So if you look at the total market across the UK, there's probably 22,000 estate agency businesses operating, most of them offering lettings to some degree. And, just people looking to retire each year flags up quite a lot of opportunity, probably, 500 to 1,000 businesses a year. And that hasn't really happened last year or this year. So there could be a significant number of opportunities next year. And with our increased footprint, having bought Hunters, more of those acquisitions become relevant and we can bid on those portfolios. So massive part of our growth strategy over the next few years. And then the final pillar of growth is best-in-class digital marketing. So we want to utilize the data we now collect across the group and be able to communicate with those customers with the objective of generating leads, residential sales perspective, lettings perspective, and a financial services perspective back to those branches. And I'm delighted to say that was launched about 4 weeks ago, and we've started running our first campaigns, and the level of interest and the leads that we've generated from a valuation perspective have been really impressive. There's a part 2 to this, which is utilising the data collected in each of the branches and some clever software in the middle that will define a referral platform. So if somebody goes into our office in Basingstoke with a house to sell in Scotland, this software will identify that and send that to the franchisee in Scotland to have a conversation about helping them sell their house.
Maybe I'll just come in there and give some financials around 2 of those, just so everyone listening can get some sort of sense of things and where we're up to at this moment in time. Ewe Move generated just about £900,000 worth of profit before tax in its first 6 months of the year. That's as much as it generated last year. Those who've joined us recently take a little while to get up and running. So we're not factoring anything from them, although we're delighted if they make a contribution. And then 2022 comes around the corner and they'll start to contribute and that ought to mean we're heading somewhere for about 2 million of PBT or more from Ewe Move, which is why comments of recent enough we made, it is significant to us now. And to give everyone a sort of idea of how that's working, we've the revenue's up 70%, the profits are up 130%, and margins consequently gone up from 30% to 40%. It's kind of following the path that we always hoped it would. And it's got a long way to go yet, but the team in Ewe Move are doing a cracking job, and clearly those who've been supporting us as franchisees in there have really progressed on in recent time, and we're delighted to see it. So that's a background to Ewe Move, and then financial services growth. Not going to see anything out of it this year. It's all preparation work. Next year we will see some contribution clearly from the activities that we're engaging in now, because leads will convert into business and we'll get royalties from our franchise network from that. And we might see upwards of 6, 7, maybe even 800,000 depending on where the market is. And then we've got a contribution to come from Mortgage Genie. Over to you, Gareth.
Thanks, David. Hunters update, going incredibly well. They've been busy. They're having the busiest ever year in terms of residential sales and obviously the integration into TPFG. But, we're probably 75% of the way through the integration piece. So it's progressing well. The increased scale is already beginning to pay dividends in terms of our discussions with suppliers and the sort of working together as a group. We've seen, obviously the enhanced database, and that with the digital marketing strategy that we've got will again drive business into the group. All of the initial synergy initiatives have been completed. There's a few more that we're working on, and in terms of the supplier piece, in terms of driving better deals into our franchise businesses, but also the better commercials for us. And the great news is, because you never know, when you take a business that has such a strong culture as Hunters did, what staff turnover was going to be like, but they've embraced it, and we have very low staff turnover in the group. And backdrop is Hunters have delivered their best ever year since they were incorporated into the group, and the results are well ahead of management's expectations. So we're delighted with the first 6 months of ownership within the Hunters brand. So, our market, I guess, if I looked at it and you did an overview in terms of the housing market, there's definitely increased interest in the hybrid model. There's more people looking to embrace that locally. We're seeing, record levels of interest in Ewe Move in terms of talking to us about taking a territory. And I think COVID's played its part in that, in people wanting to have this sort of work-life balance that is different to before. And that plays into our sort of Ewe Move strategy. I think also that, David touched on, the sort of hidden gem that we keep talking about that is Ewe Move. It's now become a significant part of the group and has the potential to grow exponentially. And we want to, really push that forward over the next couple of years. But it's now more mainstream, and that's really good news. In terms of where we're at from a property market, we started this year thinking at some point this busy market would stop. And whether that was in March when the first sort of stamp duty cliff edge was supposedly going to come in, or later in the year, we didn't really know. Clearly, the March stamp duty deadline was extended, and we had the June spike, and now we're going to have the September spike this month. But to give you some comfort about the market is as busy in September as it was in February. Friends of mine, bit of anecdotal, friends of mine, daughter put the house on the market in Nottingham 2 weeks ago. Not the best area in Nottingham, not the worst area, mainstream, 3-bed terrace, around about £260,000. In 2 days, she'd had 43 people request to view the property. Within a week, she'd had 100. And she sold it within the first week for something like £20,000 above the asking price. Okay, so demand is unbelievable. 99 people missed out on that house and are therefore looking for another terrace property in Nottingham. And that sort of anecdotal feedback is every time a property goes onto the market, you get multiple viewings, you get offers very quickly, you get offers above the asking price more times than not. And therefore, the market currently is as busy as it was at the start of the year. There's a shortage of stock, and that's, I guess, what is, slowing it a little bit. And we certainly saw that in July and August as people sort of just took some time off and went on holiday. But again, last week, the number of valuations that were booked and the number of instructions that came to market across the group was back to sort of February levels. So for the time being, the market's as strong as it was. That's very soon going to move into 2022's activity, because what you sell in October, November will convert in January, February of next year. The thing we think about all of the time is what's going to stop this market. But what's probably not been noticed is that as this market's been sort of growing, mortgage affordability has been reducing. So the deals that you can now get on a 2-year, 3-year, 5-year fixed rate mortgage are lower than I've ever seen before. Some 5-year fixed rates at below 1%. And the correction in most housing markets coincides with either a recession or interest rates going up, because most crashes have had a big repossession market for the 2 years after the downturn. With mortgage affordability and employment at sort of record numbers, you struggle to see what's going to stop it in the short term. So it is a little bit crystal ball. If I look at what Savills are saying, Savills said back in March that there would be about 1.5 million transactions this year, and I think they'll be about right. And they said for the next 3 or 4 years there'll be 1.2 million. So that's factoring a 20% reduction. But actually, if you look back to 2019, that would be a 20% increase on what estate agents used to survive on. So as I say, it is crystal ball stuff, but that gives you some context in terms of what's happening in the market today. No downturn in demand, desperate for stock to come to market, and that stock will sell very, very quickly once it comes to market. And you know, what are we predicting? A sort of gradual move towards more traditional trading patterns. Not a massive crash, but a gradual move back to that 1.2 million transactions. Okay, so how do we see the outlook? Exciting period ahead. Trading state remains encouraging, as I've just talked about. Strategic initiatives continue to support growth momentum. And I think irrespective of the market, I'm really confident that the strategic growth initiatives that we put in place a year ago will drive the bottom line performance of the group through 2022 and 2023. And that's reflected in the note that was put out yesterday. You know, our focus, our day-to-day job, focus on fully integrating Hunters, driving the Ewe Move recruitment and developing our financial services division. They're the big top three that we're going to focus on as a management team. Macro environment will drive future demand. So that's both across the lettings business and the sales business. You know, we've touched on the sales market. There's incredible demand in the lettings market as well. So stock shortage there, and that will drive rents going forward. And our ultimate goal, again, talked about it last year, is to support our franchisees in order to help them become more successful and more profitable. Because if they make more money, we ultimately make more money. Full year profit to be ahead of expectations, as David talked about, due to strong performance and a really positive outlook. And just you know, those key headlines, you know, £1 million better than forecast at 9.3, and a really great dividend in interim dividend and the prospect of a really good dividend at the end of the year. That's the end of the presentation. We now would like to throw it open to any questions you may have.
And we have a question here. It seems the majority of the contribution from Hunters in half one has come from their owned offices. Is the intention to franchise these out in the immediate future? If so, what roughly do you expect the disposal proceeds from these offices to be, and what would their expected contribution be going forward as a percentage of their revenue as owned offices?
Okay, I'll try my best to answer that one. I think if you're talking about at a revenue level, there's more contribution from the owned offices than there is from the franchised. If you to look at profit, that's probably not the case. But then in the first half of the year, Hunters hasn't contributed too much to our profit before tax. So you know, there we go. Would we franchise out? Well, I don't think we're ever going to franchise out the lettings element. That's in our DNA, and we'd rather like to grow that, add a few more portfolios to it, and get the benefit of it. So it would just be down to the sales offices. It is in Hunters' DNA. That's where they came from. They owned and ran offices before they became a franchisor, so they're good at it. You know, would we look at one or two being franchised off? I suppose we would if the offer was right. Why not? But it would only be the sales element. So otherwise, no. Our focus really is on improving the margin out of those businesses, which we see through lettings, and thereby giving it some stability as well. Because the sales market may go back a little bit, may go back a lot. We never know. So what we've got to do is just make sure that we keep maintaining that contribution, and that's what we'll do.
Thank you. And leading on from there, is the 50-50 sales lettings split referenced in relation to overall revenue, i.e. includes owned offices or just MSF?
No, it's just looking at MSF. Yeah. So, I mean, I'd add to that. It's driven at the moment just by, you know, where the market is. You know, lettings has still shown some very good growth this year, and you know, underlying like-for-like growth of 9% is good in the lettings space. And as the market, our sales market undoubtedly softens at least a little bit, the contribution from lettings will start to flow through, plus our own activities and just driving lettings, which we'll do both at an own level in the offices and encouraging Hunters franchisees to engage in lettings more, because ultimately that's important for the value of their businesses and their retirement plans. So yeah, there we go. That's the journey we're on. It won't always stay at that level.
Great, thank you. There was a substantial increase in the dividend, for which thank you. The results speak of a progressive policy. Should shareholders expect the current levels and increases are reflective of a very buoyant market? Or is it the board's commitment to a progressive dividend policy from the current levels? And thank you very much, and congratulations again on excellent results.
Well, thank you for those comments. Is it our intention to? Well, we first thing for us, dividend policy and dividends has all been about sustainability right from day one. So it's what can we afford and what can we sustain. Plan never to go backwards in our dividend. That drives us. The current level that we think is reflective of where we've got to as a business. 11.5p, might sound a big increase from where we've been, but we look at it and say we can more than afford it, and going forward we'll continue on that. As we generate the earnings, we will share those back with our shareholders, and if it's 11.5p in 2021, which it may well be, then our plans are for it to be more in 2022. That doesn't, as a group, leave us with a position where we don't have the cash to engage in acquisitions that would help us or help fund a few things through franchisees. And indeed, our funding partner, Barclays, are very keen, if we wish to draw on their funds as well. So we're well positioned, strong balance sheet, good cash generation. I think that leaves us with an ability to maintain a progressive dividend and invest as and when we need to.
Thank you. And what operating margins are you targeting for the financial services arm, and when do you expect to achieve them?
I'll pick this one up as well, Gareth. Well, if he's, I've been in financial services for a long time. If you start looking across the market, small operators, 10-15% will be a good operating margin. Bigger operators will try to champion 20 or 25. Where do we want to be? Well, we want to be on the upper end of 25. We've got a lot of business we generate internally. So unlike a lot of models where they're having effectively to pay for leads in order to turn them into business, we won't have to. So if we're clever in the way that we run our own businesses, so Mortgage Genie, if we buy something else, that as well, we should have a higher margin. We should have 25-30%. And then in the model we've set up for the network, at the end of the day, we're just earning off the activities they engage in. So we're taking our 9% royalty. So that will have very little cost attached to it, and whatever goes in as revenue will end up on our bottom line.
Great, thank you very much. Could you give us a bit more colour on why Richard Martin stepped down to Deputy Chairman, and whether he's a committed long-term shareholder?
So Richard turned 70 last year in the COVID year, and I think that was a pretty big milestone. And if I look at it from my perspective, being here, just short of 2 years, Richard has been incredibly supportive, incredibly engaged. And will continue to be so as deputy chairman. So I think it's he's hit 70. He wants to go and enjoy his life, and he wants to spend a bit more time with his family and maybe taking some holiday. But Richard's commitment is that he's still 100% engaged, wants to be involved day to day, and will carry out the role of deputy chairman. David's known Richard a lot longer than I have. So your take on it, David?
A bit of the passing of the baton for me. Richard and I had a good conversation before I joined. We kind of set out what needed to be done and the journey we'd like to go on, and then we went off and floated and done all the other things we've done since. And he's been tremendously supportive. He's always positive about everything. He'll even in a very positive way point out the pitfalls to something they're considering. So it's a combination of I guess mentorship, leadership, and just being a really good business partner and being able to be open and discuss things. And most of that won't change. It's not going to change Richard, and it's not going to change our interaction with him at all. He might sell a few shares, but I'll tell you, he's been wedded to that shareholding for a long period of time. Ian and I tried for many years to persuade him to sell some shares and improve the liquidity in the market, and he's done a little bit of that, bit more recently. But yeah, like everything, we're a bigger business now. I'm sure he looks at it and says that I need to help that liquidity as well. So you know,
I mean, one thing to add to that, Paul's also been with us since float. So Paul and Richard work really well together, and you know, they're just reversing roles, and yeah, it won't be much of a change, I don't think. So you know, we're looking forward to Paul taking over chairmanship, and looking forward to continuing the relationship with Richard.
Excellent, many thanks. Would Winkworth be an attractive fit, or does it have too much overlap given the London concentration?
It's a great business. I think, you know, you know, when we were looking at, you know, potential targets, you know, there's not many to look at really. There was Hunters this time last year. There was Winkworth, and there was Belvoir, I guess. And you know, Winkworth's a really well-run business that has, you know, a lot of real attraction, but it's, you know, pretty much 70% of it, I think, is family-owned by the Agas family, and you know, I think they're happy with the way it's set up currently.
Thank you very much. And can we expect the current levels of Ewe Move recruitment to be sustained? I expect the current conditions have helped recruitment. Can you talk a little bit about churn within the Ewe Move network and how this is expected to evolve if the market softens?
Yeah, really good question. So start with the recruitment piece. So the recruitment piece, I don't think is as a result of a busy market. I think it's a result of COVID and people choosing to do things differently. That work-life balance, run their own business. That's certainly what we've seen from the people we've attracted in over the last sort of 9-12 months. In terms of churn, you know, we're very sensitive to this because, you know, ultimately we have a recruitment process that we put everybody through. It's not we will sign up with everybody. That is, you know, they come on a discovery day. They look at the territory. They assess their knowledge of the territory. We agree what the territory is going to be, and finally they have a sign-off interview with the MD, Nick Neal. Nick Neal was a Ewe Move franchisee, successful Ewe Move franchisee, knows what it takes to run a business within Ewe Move, and shares that with each and every franchisee that says they want to become buy one of the territories. We probably reject at that stage 30%. So 30% get through to that final stage, and we say, no, we don't think you are suitable. So Nick is, you know, passionate about who comes into the brand, wants to make them successful. But do we get it right every time? No. You know, do we get it right more now than we did? Yeah. You know, a lot of the attrition that we saw was in 2014, 2015, 2016 for reasons probably David will be able to articulate better than me. In terms of the attrition in 19, 20 and 21, it's actually quite low. David, do you want to talk about the history of Ewe Move and post-acquisition?
Yeah, well, I mean, post our acquisition, the two major events. One, we wanted to put it on a more commercial founding than it was, and some people didn't agree with us over that, and they decided that they'd like to lead the franchise, and that's fair enough. And then the founders themselves decided that they wanted to leave and go and do other things, and that was unexpected for everybody. They'd given a commitment to the franchisees, and then they changed, and again that signaled a change, and people decided to leave. And then, you know, you've had a couple of tough years. I mean, you know, there's probably 17 through to first quarter of 2020. You know, they were tough sales market years, and then you've come into quarter one 2020, and things are a bit better. But you know, overall, not the easiest place in which to start and build a business, and people have tried very hard during that time, I'm sure to do so. And now what do we see? We're probably seeing the maturing of Ewe Move as a franchise offering. We see, you know, we see very few people leaving who are not trying to resell, which is good because that's what normally happens in a franchise model. We see the odd party exiting right now, and that's encouraging to say that that's slowing down. Everything's about retaining everybody as best we can. We see 10 of those 37 sales in the first half of the year coming from existing franchisees who are ready to expand. And when they've got relatively small territories compared to normal franchises, which have 60 to 80, 90, 100,000 households, whereas these have got 20, 25,000 households, if they've grasped the model and they understand how it works, then they can start to also take on associates and build up the business around them. So we're in that maturing stage, I think, now. And that's not to say we won't have a few people who won't decide that it's not for them, and we won't have a few people for one reason or another. Life is challenging in the best of times for most of us, one way or another, who take their eye off the ball and things slip. But and the greater majority of franchisees, I think, will stay with us, and we'll start to see that number operating keep growing and growing and growing. Fewer cases of people, I won't say they're casualties, so it depends on circumstances, but fewer people for whatever reason having to exit, and I think that's the pattern we're on.
Yeah, and we're bigger. We're a year older. We've got 150 territories instead of 150. So all that becomes easier and aimed at sort of retention. So the brand's more recognised. We were awarded the best estate agent award and best letting agent award in 2020. So that offering's becoming far more mainstream, more accepted. But we will also invest in training and as David called them earlier, boot camps. We get our best franchisees training our struggling franchisees to show what they did to grow their business, and that's really important and really useful. And there's a real family sort of feel to everybody wanting to help each other to make that Ewe Move brand significant in the marketplace. But we'll keep working on it. It's very much on top of our sort of to-do list and our radar. So we're very sensitive to it.
Thank you. And for the group as a whole, what market share do you estimate you currently have in terms of sales and lettings, and what do you aspire to have?
So I think David touched on it earlier. I think in terms of the sales market, probably, somewhere between 1.25 and 1.5% of total transactions. In terms of the lettings market, a little bit higher. There's massive market share that we can still drive for. They're significant numbers when added together, but there's still, in every location, plenty of lettings properties to go at, a huge amount of market share from a residential sales perspective to go at. What would we want to do? We'd love to double it. I'm sure that would probably be a little bit ambitious, but plenty of opportunity. And I think with our digital marketing strategy, that will increase. I think there are things that we will do over the next 2 years that will drive our market share. What will drive it to, I can't say, but we are very, very focused on making each individual unit more successful than they are currently. And that's all about increased market share.
Thank you. And are you planning to make more acquisitions in the financial services space?
Certainly look at them. They represent really good value for money, good margin. The deal we've done with LSL gives us, a really great platform to be able to integrate additional financial services businesses into the group. So I wouldn't say no. Is it an absolute priority? No, I think the priority for the next year is to get what we've got right. But if an opportunity presents itself, I think we've demonstrated in the last 9 months that we're not afraid to, acquire businesses, and that will continue.
And that's the end of questions. Gareth, do you have any closing remarks?
Brilliant. I'd just like to say, one, thank you for your time and support. We are really excited about the next 12, 24 months. I think we've got, the starts of a really good story and delighted to deliver the results we have done this week. And thanks for your ongoing support. And I look forward to updating you in 6 months' time.